Efter ett starkt fjolår verkar amerikanska aktier vara på väg mot ännu ett utmärkt 2025. Det tror flera strateger. En av dem sitter bredvid mig, Karim Chedid. You're an investment strategist for Blackrock. Wonderful to have you here in Stockholm.
Thank you.
First of all, you stay positive to risk and you stay positive to American equities in the new year. Why?
So when we look at some of the drivers of the bull market that we've seen in equities generally, including the US stock market last year, we see those drivers continuing. So first we have earnings. Earnings have been delivering quite well in the rally. So whilst multiples have expanded in the US equity market, they are backed by earnings growth. And second, that earnings picture is starting to broaden out. So if you look at the earning growth expectations of 2025 for S&P 500 and for S&P equal weight, which shows a breadth in the index, both are looking at around 12 to 13% growth. So they're similar.
Earning growth is not concentrated to the big 7 names that we talk about all the time. You have that on a broader scale.
Exactly. Whilst the big 7 names are positive, they're no longer the only ones that are positive. And so that gives some comfort that the rally can endure. And then when we look at it from the macro perspective, the growth picture in the US has remained fairly positive, and that is a tailwind.
How do you have any advice on how to approach these? There's a few 7 names, obviously, that a lot of people have been interested in. You're still positive on those, but you mentioned a broader indices as well, an equal weighted indices where every name in the S&P 500 is weighted equally, I presume.
Exactly.
Do you choose one of those strategies or do you go with both?
I think you go with both. So what we have been doing is looking at how we could evolve this type of equity allocation to really take control of when you're leaning into concentration and when you're leaning into breadth. And the one way to do it is to look at a mix of building blocks of S&P top 20 type of index, which is even narrower than the 500. It's just going into the mega cap, the top ones, and S&P equal weight, which is the breadth. And here, by doing that, you can control when you want to lean into one versus the other if you want to be dynamic. Or you could do a mix of 50-50 or 45-55 of both, which essentially leans away from the middle names and helps you achieve the breadth in that earnings picture as well as the concentration in those scale names.
I want to talk about some other regions too, but essentially this is a bet that US exceptionalism continues in the new year.
In a sense, yes. I mean, there's a lot of innovation, the tech story, the AI story, all of these are very well represented in the stock market indices in the US. But this doesn't mean that you ignore the opportunities in the rest of the world, because there are many. You just have to be a bit more selective with them beyond the index, especially in Europe.
We're all very negative towards Europe. Sadly, the discourse has been one of pessimism as of lately. But where do you see opportunities in Europe?
Yeah, I think there are opportunities in Europe in dispersion. So when you look at the dispersion of the European stock market, it is at the highest level since 2009. So that's pretty impressive, since then. And I would see opportunities in sectors like luxury and healthcare. So that's the sector dispersion, focusing on the sectors that have strong secular stories that are very supportive of continued earning strength. And I would also see on a single stock level high dispersion within those sectors, focusing on quality names.
Would you say that the luxury bet is, you mentioned secular, a longer trend that's very strong, but there's a lot of worry about consumer, at least in the shorter perspective, about consumer strength, both in Europe and in China. Any thoughts on timing here? Is this a long bet, or do you think the timing is right this year as well?
I think it's both. There are a lot of names within that sector that have really shored up long-term order books that are very resilient and have become more of quality names with steady cash flow. So this makes them rank highly in metrics like ROE, free cash flow, and then there is also a timing this year. There was a bit of a pullback in the sector last year on concerns about the consumer that you just mentioned, which creates some good entry points.
If we move from equities to fixed income, there's been a fascinating move in the US where obviously 10-year long maturity yields are going up instead of down, while the European trajectory, seems to be heading in a different way. Any thoughts on where to go there?
Yes, so I think in fixed income, the main theme is, if you reflect on 2024 lessons, duration, so the rate component has been volatile, but the spread component, so the carry in fixed income, has been a bigger driver of returns, and a positive one. And so we lean into that theme in 2025, this idea that in fixed income generally, especially through active management, unconstrained, flexible type of strategy, a mix of corporate and government bond strategy that is high quality can still achieve you really good income in today's environment. And this is a very big opportunity. However, on the duration side, the rate side, where there has been volatility, that volatility is likely to continue. And that means you need to think about diversifiers in your portfolio. And I'll come back to that in a second. But to answer your question more directly, on the central bank divergence theme, this is the other big theme in fixed income. We expect that the ECB will continue cutting rates back to back, but the Fed will pause and will cut much more modestly this year. And this creates an environment where you can go long duration, long European government bonds, but stay more cautious on US duration, so US government bonds.
So more of the same dynamic that we've seen last year will move European bonds and would keep US bonds, the long duration.
Higher rates for longer.
Higher rates for longer.
Exactly.
That's quite interesting. You mentioned volatility in the portfolio. If I have a 60-40, 60% stocks, 40% government bonds, it's been a little bit too volatile. It hasn't really worked as well as you would wish. Your thoughts on that?
So we have been looking at ways that we can include portfolio diversifiers in a stock bond portfolio, because that stock bond correlation has become unreliable. There are periods where it's negatively correlated, which is good for portfolio diversification, for risk metrics of the portfolio. And there are periods where they are positively correlated, which is bad if that positive correlation is in a downtrending market. And this is what we saw over the holidays for anybody who was checking their phone over the past few weeks.
I'm sure you have.
And so that means you need to think about strategies like market neutral strategies in liquid alternatives that can achieve that sort of cash plus return that is unrelated to stock bond correlation, or scarce assets, what we call scarce assets. So these are assets that have a defined supply. Gold is an example of this. And I think it's one of the reasons why gold was up more than 20% last year and should continue to do well.
So hedge funds or market neutral strategies and gold and silver as an addition to the traditional bond component in a portfolio. That's quite interesting, Karim Chedid. Wonderful to have you with us here in the studio. Thanks for joining.
Thank you for having me.
Det här är en podd av EFN Ekonomikanalen. Ansvarig utgivare är Leo Lagerkrans.